Markets are still on a roller coaster ride as we continue to see short-term rallies followed by sharp pullbacks as markets overreact to macroeconomic data. Given this short-term market uncertainty, it's best to position our portfolios in the safest way possible. As you're tuned in, we'll make sure we give you the best insights on how to preserve your wealth while making sure you won't miss potential rallies in the stock market. Our goal is to help you on your journey to financial freedom so you can live life on your own terms. And in this video, we'll explore our top 5 dividend stocks to buy right now. If you like this video, make sure to destroy the like and subscribe buttons so you won't miss any of our future content. Make sure to stay till the end as our last stock pick is our favorite and we think you'll like it too. Now let's get right into the video. Now let's talk about dividend stocks. Stocks of companies that regularly distribute dividends to their owners, typically in the form of cash payments, are known as dividend stocks. Buying the finest dividend stocks can be a fantastic strategy to build long-term wealth in addition to being a valuable source of income. First up, we have AT&T. AT&T offers media, technology, and telecommunications services. The company provides wholesale services, telecommunications equipment, managed networking, local and long-distance telephone services, data broadband and internet services, and wireless communications. Additionally, AT&T distributes feature films, television, video games, and material in both physical and digital formats. It offers residential consumers entertainment and advertising services to both small and large businesses. At the start of the COVID-19 outbreak back in Q1 of 2020, AT&T's stock price plummeted by roughly 32% from a range of $28 to $30 a share from September 2019 through March 2020, down to $19.70 a share. While this presented a window of opportunity to accumulate AT&T at a discounted price point, today's market downturn has presented us with an even better opportunity. With the reduction of 5G capital spending in the sector, AT&T could become a huge cash flow machine again. AT&T saw stronger than expected Q3 customer gains in postpaid phone subscribers at 708K and fiber subscribers at 338K, whereas Verizon only booked an additional 8,000 postpaid phone subscribers for the same quarter. AT&T's growth continues as it booked 3.6 million postpaid phone subscribers and 1.2 million fiber subscribers in the last year alone. Based on the data we've gathered, AT&T's revenue has grown from $127 billion in 2012 to a whopping $169 billion in 2021. That's an average of $155.2 billion over the past 10 years. Its operating margin has averaged 11.9%, from 11% in 2012 to 13% in 2021, and its return on invested capital has averaged 8.6% over the past 10 years. Based on our conservative estimates, AT&T still has a lot of room to grow, and based on our model, the stock is estimated to make an average return of 18.1% annually over the next 5 years when you include the dividend returns as well as the growth in the share price. If you're looking for some of the most solid stocks with high dividend yields, AT&T might just be one of your top picks. Next on our list is Verizon Communications Inc. Verizon Communications Inc. offers communications, information, and entertainment goods and services to individuals, organizations, and governmental bodies. The consumer division offers wireline and cellular communication services and goods that are geared toward customers. The business division provides a range of Internet of Things IoT services and products, including video and data services, corporate networking solutions, security and managed network services, local and long-distance call services, and network access. The company's headquarters are in New York, and it was established in 1983. Prior to the COVID crash of March 2020, the stock has been trading from a range of $54 to $62 and sharply plummeted to $49 due to extreme market fear, but while most stocks have crashed more than 50%, Verizon only tanked 20% from its previous peak. Today's prices are much worse, yet have presented us with better entry points if we want to accumulate an industry titan like Verizon Communications. The world's premier technology creator of Player X, the newest online fantasy esports platform, World Champion Fantasy WCF, and Verizon announced an exciting multi-year contract on October 31st, 2022. The partnership will incorporate Verizon's tech stack, tools, and services into WCF's innovative and market-changing Player X platform. According to Mike Corrales, VP of Business Markets at Verizon Business, while the way people watch, connect, and participate in esports evolves, Player X is relying on 5G to bring the pinnacle of immersive esports meets fantasy sports experiences for fans. We are thrilled about the chance to work with such a creative, forward-thinking organization that is prepared to unlock the full potential of the fast-expanding esports and gaming industry. Looking into Verizon's numbers, despite its price slumps, Verizon has booked steady revenue growth from $116 billion in 2012 to $134 billion in 2021. Its operating margin has steadily grown from 7.5% to 10.7% in 2021, with an average of 12.5% annually over the past 10 years. What's more, the return on capital invested has increased from 7.5% to 10.7%, averaging 10.9% annually over the same period. Our model suggests that Verizon Communications still has more room to grow and can potentially yield 21.8% annual returns over the next 5 years when you include returns from the dividend and share price growth. Based on this evidence, we think that this stock is indeed a gem, trading at an extreme bargain. Next up on our list is a company truly familiar to us, and that is Best Buy BBY. Retailer of consumer electronics, Best Buy has locations in the United States, Mexico, and Canada. The company sells a wide range of goods at its physical stores and online, including mobile phones, digital cameras, video games, music, and household appliances, like refrigerators and washing machines. Through its Geek Squad brand, Best Buy also offers repair services for computers and other gadgets at its physical locations. As Americans upgraded their home offices for a new routine of remote work, the shop was one of the few to prosper during the epidemic, posting a 144% gain in U.S. online sales and an 8.3% jump in overall sales in 2020. Prior to the COVID crash in March 2020, Best Buy's stock price had risen from $48 to $92 from December 2018 to December 2019, yet plummeted to $50 in March 2020. Since then, the stock has recovered from these lows and even surpassed its previous pre-pandemic peak. Its price has consolidated between $100 and $127 till the end of 2021, yet due to the current macro climate, the stock lost most of its post-COVID crash gains and settled at a range of $62 to $68 at today's prices. The operational environment at Best Buy is becoming more difficult. The business anticipated reduced sales for the year due to challenging comparisons driven by pandemic-related demand for technology goods and services, which was supported in part by stimulus funds. It was also correctly predicted that consumer spending would significantly move toward experiences like travel and entertainment. Best Buy did not account for unprecedented inflation and its ensuing effect on demand. Trading down is common among customers from lower-income households, especially in the television category, and Best Buy is noticing an increase in interest in sales occasions more generally. These may all sound negative, but if we closely look at their numbers, they definitely tell us a different story. Best Buy's revenue has steadily grown from $44 billion in 2012 to $51.7 billion in 2021 and averaged $43 billion in the past 10 years. Its operating margin has grown from 5.5% to 7.7% in just 10 years, with an average of 6.2% annually. Furthermore, its return on invested capital has significantly grown from 21.6% in 2012 to 59.2% in 2021. That's an average of 28.2% per year. Our model suggests that in the next 5 years, Best Buy is poised to deliver at least 17.4% returns with an average dividend yield of 4.2%. Coming up next is a company called Total Energies, TTE. One of the biggest publicly traded oil and gas corporations in the world, Total Energies SE, has more than 100,000 employees working in more than 130 nations. It is ranked among the top 2,000 public corporations in the world, according to Forbes. Total Energies operates through 3 segments: exploration and production operations, refining and petrochemicals operations, and ship and market. The exploration and production operations segment focuses on the exploration and production of oil and gas, renewable energies, solar and wind energy, and bioenergies, renewable low-carbon resources. The refining and petrochemicals operations segment includes refining and petrochemicals, electricity, and specialty chemicals. The ship and market segment includes operations of trading and shipping, providing services and products such as fuels, lubricants, bitumen, natural gas, special fluids, and fuel additives or power and solar photovoltaic solutions. Prior to March 2020, its stock price was trading between $48 and $55, yet had crashed to $22 at the height of the market fear brought about by the COVID-19 outbreak. Since then, its stock price has slowly recovered back to its peak levels. In fact, its current stock price now is exactly where it was before the crash of 2020. I get it, there's a bit of FOMO in the air, but don't fret since we're still seeing more upside with this stock. Following a settlement last month that ended a long-running maritime border dispute between Lebanon and Israel, French oil firm TotalEnergies announced it would shortly begin gas exploration activities in the Mediterranean Sea off the coast of Lebanon. The settlement was mediated by the United States. A framework agreement was reached with Israel, opening the possibility of exploration in the so-called Kana field, according to a statement released on Tuesday by TotalEnergies and its partner, Italian company Eni. The Maritime Boundary Agreement has been praised as historic and advantageous for both parties. It is the first substantial diplomatic achievement between the two nations in a long time. While this presents endless opportunities for the future of the company, let's dig into the numbers to see if this stock is worth every penny. Total's revenue for the past 10 years has averaged $176 billion, which has gone down from $234 billion in 2012 to $185 billion in 2021. Yet its operating margin has increased from 19% to 21%, with an average of 16.6% over the same period. Return on capital invested has averaged 8.4% annually over the past decade. Its average dividend yield for the year is 6.2% and is steady. Now, this stock is worth picking if a strong dividend yield is what you're looking for. Based on our model, Total is still poised to deliver around 13.5% annual returns over the next 5 years. Last but definitely not least is a company called Ryder System, R. You may not have heard of this company yet, but Ryder System Inc. provides full-service transportation solutions, commercial vehicle rental, scheduled maintenance, truck leasing with over 523 operating locations, and integrated supply chain logistics across all of North America, Canada, Europe, and Latin America. Ryder oversees a fleet of more than 500,000 automobiles and more than 68 million square feet of organized warehouse space. Its stock price was trading around $45 to $58 prior to March 2020. The global turmoil brought on by the pandemic has hammered the stock price down to $23, roughly 60% from its previous high. But out of all the global stocks that crashed to fresh lows, Ryder has been one of the companies that have not only recovered back to its 2017 peak, but has remained there even during the duration of the current bear market. Ryder has recently acquired .com Distribution, a provider of omni-channel fulfillment and distribution services for high-growth retail and e-commerce businesses with a focus on health, beauty, and cosmetics, and fashion and apparel. With the acquisition, Ryder is able to add an amazing list of consumer brand names to its e-fulfillment network and grow its national footprint by acquiring a 400,000 square foot multi-client fulfillment facility in Edison, New Jersey. In order to ensure a smooth transition for consumers, .com Distribution's seasoned leadership team, including founder and CEO Maria Hagerty, and the business's operations staff, numbering over 100 full-time employees, will also join Ryder. Because of this, Ryder's omnichannel fulfillment and e-commerce solution now deliver to all of the United States within 2 days and 60% of the US within a single day. Looking into the numbers, Ryder's revenue has grown from $6.2 billion to $9.7 billion over the past 10 years, with an average revenue of $8 billion per year. Operating margin has significantly increased from 19.8% in 2012 to 27.5% in 2021. That's an average of 24.2% annually over the past decade. Its return on invested capital has also increased from 5.6% to 7.8% over the same period. Our model suggests that Ryder is still poised to return around 13.8% annually over the next 5 years with the help of its attractive business model. There you have it, folks. Those are our top 5 dividend stock picks to buy right now. Comment down below your favorite stock pick, and if you enjoyed our content, don't forget to hit the like and subscribe buttons, and we hope you have a truly amazing rest of your day.